Recently, the capital gains tax on stocks has become a major debate among politicians and investors. But what exactly is it to spark such an intense debate? Today, we'll explore capital gains tax by reviewing similar systems and the current situation regarding the taxation of stock capital gains. What is the capital gains tax? Capital gains tax refers to the tax imposed on the profits earned from selling valuable assets, such as stocks or real estate. For example, if person A purchases stocks for 10 million won and sells them for 20 million won, the tax imposed on the 10 million won profit is the capital gains tax. Capital gains tax is also imposed when buying and selling real estate. Gift tax and inheritance tax. Gift tax is imposed when a living person transfers property to another person without compensation. For example, if parents give cash, stocks, or real estate to their children without compensation, a gift tax is imposed. However, not all pocket money from parents is taxed. Property given by parents to children is exempt from gift tax up to 50 million won over 10 years. Inheritance tax is imposed when inheriting property from the deceased. Inheritance tax is not imposed on amounts up to 100 million won. In summary, capital gains tax occurs when property is transferred for compensation, while gift and inheritance taxes occur when property is transferred without compensation. Ongoing capital gains tax controversy. The recent major controversy over capital gains tax began after the ruling Democratic Party proposed a tax reform plan that sharply reduced the threshold for major shareholders, who must pay capital gains tax, from 5 billion won per stock to 1 billion won. Supporters of the plan say that lowering the threshold would ensure high net worth individuals contribute fairly. They argue the previous 5 billion won limit was too high, potentially allowing even very wealthy investors to avoid paying taxes. They also emphasize that the measure would expand the range of those who are subject to tax and ensure sufficient tax revenue. On the other hand, opponents worry that lowering the threshold could drastically increase the number of major shareholders, causing more investors to leave the stock market. They are also concerned that abruptly changing the tax threshold could lead investors to sell large volumes of stocks by year-end to avoid taxes, potentially adding to market volatility.